Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Today's special guest is Chris Miles, the cash flow expert. Chris is a leading authority on how to quickly create cash flow and create a lasting wealth and legacy for you and your family. He's been featured in U.S. News, CNN Money, Bankrate, and does have a high reputation for getting clients life-altering financial results in his company, Money Ripples. Interesting things about Chris is he retired the first time at 28. And what I loved about this episode is, we dove deep into the markets, real estate, investing, what we're seeing, and what other people are seeing. So Chris speaks to tons of people out there. He's got ear to the ground in real estate and the stock market. And he's giving his opinion of where he sees things headed, not just what you're seeing on the news or reading on the internet. So hearing from an industry expert, all things investing in real estate. So hope you enjoy this episode that I have with Chris Miles of Money Ripples. Chris, thanks for being here today. How are you?
Hey, doing fantastic, Chris. This is like the show of Chris Squared or whatever it is, huh?
Yes, exactly. So thankfully, we don't have a third person saying Chris or asking us questions. But, so as we were chatting a little bit earlier, today's episode, as we mentioned, we're going to be really talking about Chris's background and what he is seeing, hearing, got ear to the ground, the pulse based on your courses, your training, and the people you work with. So love to hear about that. But before we get in, typical intro, why don't you tell people, hey, what are you doing today and how did you get to that point?
Yeah, today I'm financially free. That's cool. For the second time. That's okay. The funny part of the story. But yeah, like today we have a company called Money Ripples where we're actually helping people find and free up cash, how to invest it, create passive income. So you work because you want to, not because you have to. You become work optional. And we even do this max ROI infinite banking strategy to help and augment it and all that kind of stuff. But I didn't start that way. Funny enough, I have a very eclectic background. Even when I went to college, I was a sociology major with a triple minor in psychology, Japanese, and ballroom dancing. So that makes sense, right? I know your face says it all. I actually was going to go into psychology, but when I was going to go in marriage and family therapy, but then after seeing how messed up people are, I was like, I'm going back to sociology. But my intent was actually going to business consulting. And as I was doing that, I thought I should have real life business experience. And so I actually started looking around, what kind of business can I start? And the first one that was fascinating to me was a financial advisor. I didn't know at the time they take anybody off the street as long as you could pass a test and not be a criminal. But on top of that, I thought if I could just learn about money for myself, that's great. But even more importantly, maybe I can give some years of my dad's life back. Because I was raised as a kid where I'd hear the common phrase you might hear too, which is, hey, we can't afford this. We think money grows on trees. I'm not made of money. Those kind of phrases were always said to me. And so I was like, I don't want to be that way. I don't want to be like where my dad penny pinched all the time and was always just taught me to just save. So of course, being a financial advisor, it fit well into that design because it was all about just save, right? Pay off your debt, just save. I thought this got to work. So I drank the Kool-Aid. 4 years in, my dad reaches out and says, when are you going to advise me? So I go back home to Oregon there and I sit down at the same kitchen table. He told me just to save money, never told me what to do with it, just save it. So I'm sitting at his table now talking about what he can do with his money. And I see that he's got a 401k. He's been maxing out for years. He paid off all of his debt, including his mortgage. The guy was 100% debt free. He did everything that Dave Ramsey would tell you to do on TV. However, I told him, I said, Dad, listen, you're 61 years old right now. If you want to retire today, you better hope you die in about 5 or 6 years because that's when you're going to run out of money. Naturally, you could see that he probably wasn't pleased with that answer. Right? He was hoping for something more magical to get him out of the job. And I was like, I don't know what you can do. And he's like, can I do this or that? I'm like, I don't know. Honestly, I can't guarantee the market's going to go up or down. You already lost a good chunk during Y2K. Now it's starting to recover. This is in the early 2000s. So I said, I really don't know what to tell you. And this bothered me a lot. And so it was just a few weeks later, I'm talking with a friend of mine that I trained to be a financial advisor, but then he does this crazy thing called real estate investing. So I'm thinking he's probably going to be broke by now. And after 4 or 5 months, he says, Chris, my life is amazing. In fact, my dad and I have partnered on some deals and we've doubled his income as a professor at the local university. I said, wait a minute. Come on, that's too good to be true. There's no way you could have done that quickly. It takes years of compounding to get to this point. He said, Chris, listen, how many of your clients are truly financially free where they don't worry about money? They all worry about money. Okay, good job. Yeah, exactly. They're all wondering if they're going to run out of money before they die, or watching CNN and freaking out. So how about this, Chris? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these same investments you've been recommending? And as I was really honest with myself, I said, you know what? I'm doing a mental inventory of everybody in my office. I would say that number is probably 0. Even the ones that have been working here since the 1970s can't retire either. There's your problem, Chris. And so I started going down this alternative investment rabbit hole, much like you're already in, right? Yeah. Started going down that rabbit hole in 2006 and learning about everything and realized it was about passive income and cash flow, not just about accumulating money and set it and forget it and all that kind of crap that you're always taught. And later that next year, when I was 28, almost 29 years old, I was financially free. I was able to retire. And that blew my mind. I didn't even think that was even remotely possible, but it did. Yeah. Now, granted, I only needed $3,500 a month to live on. It was not as hard as it is today in my mind, right? Because it's not hard to get to $3,500 a month, especially with some certain types of alternative investments. Mm-hmm. But for that time, I was hoping I would do it by 40. And here I am 28 years old doing it. And so, of course, I came out of retirement to teach people how to do the same thing. And the recession kicked my butt after I came out of retirement to start a business with another partner. And we're focused on real estate investors. They're all going broke. And of course, and by the way, in this time, I also, in the mid 2000s, I was doing stock coaching. So I was even teaching people how to, buy and sell and trade stocks and options, things like that. Like I said, I have a eclectic background for sure. I'll tell you though, nothing beats real estate other than having your own business, of course, which is great. That's a great way to make millions, if not billions of dollars. But real estate for the person that's trying to invest, hands down, I haven't seen anything better out of all the things I've done from the stock markets, bonds, options, trading, you name it, to real estate of all sorts. This, what you talk about here, Chris, is the thing that really it's not guaranteed, but man, it has a much higher success rate than almost anything else I've ever seen.
The interesting thing with real estate too is, and again, it could be just where I've always lived and so forth. I've lived in Massachusetts and Virginia. If you go to somebody and say, at a party and so forth, and they say, oh, what are you doing? It's, oh yeah, I'm investing in real estate. Everyone's like, ooh, tell me more. If you say, and even like today, crypto, people would be, because they don't understand it. If you say, I'm invested in Microsoft or I'm invested in NVIDIA. Okay. Yes.
So is everybody else.
Yeah. So is everyone else. But when you say real estate is like an ego bump for anybody, especially it's a male driven industry, but all people, it's, I've got a rental or I got this. People, it's similar. It's almost like you feel back in the day, like when I grew up, my parents didn't own real estate or any additional properties and stuff. And the people that did, you looked at them as, oh, they're a higher class. Oh man, they're creating passive income or this. And this is before the internet and before, if you want a home, you get at the local grocery store, see what homes were for sale. And you'd never know what an investment property was or wasn't. The advent of the internet has made things so simple to give people, if you're a mover or shaker, you can definitely move a needle based off of where we are currently today in history.
Absolutely. It's true. And it's funny too, because I know when I mentioned I do like investing or real estate investing, people are like, oh, okay, so you're like a slumlord, right? No, actually, I'm on the passive side of this thing. Yes, I do own properties. And yes, there are people that pay me. I just don't know their names. Yep. That's something that the property manager deals with now. So it's much different for me, being a passive investor versus a little bit more of an active investor like in the mid 2000s.
You, again, have gone through and retired twice and stuff, but you still are really, coaching, mentoring, and doing things still today. And I'm always interested to hear, because I think over the last 5 years, there's been significant shifts in investing. And I'm starting to see, for what we see is, especially in real estate, 4 or 5 years ago, you could have been out in a boat in the middle of the ocean and not even know what's going on in the world and made money in real estate. You didn't have to do anything. Today, it is a much different business. Everything is. I think I just read something today that they're saying the S&P is going to average 3% per year over the next 10 years, which again, that's like predicting the weather. But I think people are more out there showing that, hey, it's not going to be easy like it was the last 4 years because the government went and basically doubled our debt over the last 6 or 8 years or whatever it is. When things finally hunker down, and example was somebody told me today in real estate, they're like, I'm buying this rental property in a highly appreciating area. It's $100,000 property. And I'm sitting there thinking, wait a second, $100,000 property is not highly appreciating area. It may have went from Flint, Michigan, and no offense to Flint, but I've seen houses go from 30 to 100,000 during COVID. But for the last 30 years, it was a $30,000 house. And I told the person, throw out what happened the last 4 years. That's like bad data that you're having. Go back to before then to see how the market acts in a I don't think
more typical fashion.
Yeah, more typical. I can't say normal economy because I don't know if we'll ever envision that. But yeah, so I'm curious, what are some of the things that you're hearing and seeing right now?
Yeah, it is fascinating. 2022 was a nice, good slice of humble pie for those in real estate. I appreciate 2022 for that reason, because whenever I hear people say, oh, I've been investing since 2018 or 2019, and I've done great in real estate, I'm like, so did everybody and their dog. Like that, it took no skill to make money in real estate. Now, to get through 2022, 2023, and in 2024, if you're still going, now you're starting to get some real good experience. Now you're starting to see some things great. And you're right, Chris, really has been in this everything bubble, as they call it, right? Everything is inflated. Everything is bubble. Inflation's inflated. Obviously, it's inflation. Yeah. But we've seen everything just kind of skyrocket. And so even people that say, I've doubled my money in the stock market in the last 5 or 6 years. Yeah, so has everybody else, right? What did you do to do that? Nothing. And that's what should have you concerned, is that if you had nothing to do with those kind of returns, that also means that inverse is true, is that if it goes down, you're helpless. You're going to act like a little victim is what's going to happen. And especially right now, the stock market, I watch that very closely too. And as well as bond rates, I watch treasuries and things like that as well. Heck, I even watch the yen because I want to know if I go back to Japan, how much can my dollar buy now? Now it's like over 150 yen. I'm like, oh my goodness.
There was that whole yen, I forget the name of it, like the leveraging of the yen because of the interest or whatever. And when they did something to their rates, it caused a big blip here that freaked everyone out, which again, that's way over my head. My wife, that's all her stuff. And that's where I let her deal with all that. I'm like, just let me stick to real estate, hun. But yeah, I mean, I'll let you keep going.
And even not even talking about the yen too, even China, like China actually just loosened all their requirements, their banking requirements. Yeah. It's almost as if you were to imagine your personal life, if all of a sudden you're like, you have this home equity line of credit for $100,000, and then the bank just comes to you and says, guess what? Good news. I'm just going to extend your line of credit to be $200,000 now. And you're thinking, oh, good, because I had almost maxed out the 100,000. That puts me in a better position, right? That's exactly what's happening in China right now. They just said, hey, we're going to loosen the banking requirements. It doesn't make banks any safer. They said, we'll just loosen all the requirements. But now there's all this extra liquidity for money to go out and be used, which of course inflates their temporarily and kind of falsely inflates their economy, which inflates ours too. So now we're seeing like this kind of like almost like when you see ripples and it bounces off the shore and comes back, it's happening internationally too. And so even in America right now, the stock market is more than double beyond what it's supposed to be right now. So you talk about the GDP actual value of the stocks compared to the actual price of the stocks. It's more than double what it should be right now. And it's been this way for several years. The last time it came back into balance was after 2008. And even then it went below and then it recovered and came back. So already imagine this, the stock market right now is over 5,000. What would happen if all of a sudden you saw your portfolio, your 401ks or whatever, drop by more than 50% in the next year or two?
That would hurt a lot of people and delay so many people from retiring. So many.
Oh, for sure.
Because they're probably not in bonds, which is.
Yeah, that's exactly it.
And I'm a believer of everything will eventually move back towards like a norm when things go up, like real estate. You're at a point or inflection point right now in real estate where in an entry level house, you've got 50+% of the population that can't buy an entry level house. One or two things have to happen. Either salaries have to skyrocket so people can afford it, but then people still have spending habits, or pricing has to come down. Now, I'm not thinking that companies are going to be cutting bigger paychecks, especially when we're in an election cycle where, parties, including both of them, are talking about adjusting the business tax rate and go. So if taxes go up for businesses aren't going to be as generous to their employees. I'm guessing. I know as a business owner, it would impact us and it would have negative consequences. But yeah. And you mentioned too, the yen. The US kind of, in my mind, in real estate does a similar thing with the fractional lending on mortgages, where that's why everyone can't go to a bank today and get their money out of the bank, is because the bank doesn't have your money. The bank literally creates money out of thin air by it's called fractional lending. They only have to hold, I think it's 10% today, and it goes down to zero sometimes, 10% of your deposit, and they can lend the rest. And basically, $100,000 loan can be, I think, $100,000 deposit ends up being like 900 or a million. Yeah,
that's right.
In loans. So
yeah, you got it. That's exactly it. And that kind of banking strategy that's the thing with banks, especially. Usually there's a financial market collapse, right?
Yep.
In some way, shape, or form. In most of these recent recessions, and tech bubble boom in Y2K, that was its own thing, but that even tied in with banks in the financial world too. But yeah, when you have banks that legally can actually loan out 10 times whatever they have in the reserves, man, that's no wonder we saw problems with banks. And the thing is, the big five, the ones that we had to bail out last time, they actually got Congress to approve a 40-to-1 ratio. So that means if you had that same 100,000 you were just talking about, instead of $1 million, they can loan out $4 million, right? So no wonder they had to be bailed out. And Fannie Mae, Freddie Mac was 100-to-1. So for the 100,000 you have there, they can loan out 10 million. So there's just all this, they just loosened everything up. And right now there's still money flowing. That's the real strength or weakness of an economy, is how much is money exchanging and flowing. What's happening is that, although the Feds, we always hear them speak out of one side of their mouth and do something else. But right now the Feds, they're still actually accelerating the printing of money. There's increasing money. They did pull back in 2022, but starting in 2023, they started to ramp it back up again. So they're still printing more to try to keep things moving and going. Stuff in the system, stuff in the banks, which are their friends because they're all bankers anyways, or at least friends of the banks. Work in a sense, they kind of work with or for the banks in a lot of ways. But they're the ones that are printing out all this money, which of course, that's why everybody's like, oh, good, the interest rates are coming down. My prediction is they're not going to come down as much as you think. Everybody's like, oh, we can go back to 3%. The only way that will happen is if we start to see things collapsing. But right now, what's happening to the Feds, I predict, I don't know, the show will go live, but my prediction is through end of 2024, we'll see little to no movement in the interest rates, maybe 0.25% if we're lucky.
That's why I was curious, because again, where people, and it's the apple orange comparison where people say, oh, Feds dropped rates, so interest rates come down. And I try and explain to people, and I'm not a finance person, I just invest in debt. So I know that, okay, mortgage rates typically follow the 10-year treasury because 10-year treasury is a risk-free rate. And if I can get 4% for that, I'm going to invest in a mortgage-backed security at 30 years. I want a 2% premium or whatever that premium is. I'm not going to invest in a 30-year product if 4% that has risk versus something that is 4% with no risk. Like, it doesn't make sense. It's no different than people who invest in a multifamily deal where, hey, look, there's a preferred equity and a common equity, and basically you can get more return on common. You should be paid more for that level of risk if you're down that food chain. And people don't understand that. They're like, oh, interest rates are going down. And I can't see them doing too much either because of where I think we just had positive job data, and I think the core influ index, whatever, popped up or was higher than anticipated. And people are kind of creating their own little storm, because the issue is, to me, the jobs data is basically, I don't want to say false, but very inaccurate in my mind. So.
Well, that's the thing, is like when you look at real life, you look at those around you, you say, they make it seem like we got great unemployment rate, but I'm hearing lots of people getting laid off right now. Even among our own clients, people that are making hundreds of thousands a year are finding themselves laid off from their companies. And to say, oh, well, no, it went down. It did go down a little bit, or not down, but like it got a little worse, went to 4% instead of 3.5%. It looks like it's getting better again. I'm like, yeah, but every time 6 months down the road, you always come back and say, oh, by the way, we were wrong on those numbers back then. These are the adjusted numbers now. And for whatever reason, Wall Street's stupid. And they're like, oh, we'll just go whatever the media tells us, whatever the government tells us. And that's why I'm so scared of those that got their money in the stocks right now, because they're just believing the numbers being put out. But then when they finally put out the real numbers, which are way worse than what they actually tell you initially, people are like, oh, it's still good. We got AI or something like that. And that's the problem. And see, you're following the 10-year treasury yield. That's an important one to follow, because that is exactly what the Feds watch too. Yeah, they're looking at unemployment. They're looking at some of these things. But the thing they're doing, I used to think that Jay Powell and all those guys, I used to think that their whole thing was to like they would determine interest rates and then all the interest rates follow. It's the opposite. They react to the interest rates. They react to the 10-year treasury. You look at what they've done throughout history, they always lag behind whatever's happening in that 10-year treasury yield. So even when I pull up my Yahoo Finance app, like I have 10-year treasury on there that I'm watching that daily, and I've been watching it climb since September, climbing its way up.
What's it at now? I haven't checked it recently, but
for 4.2.
Yeah. So mortgage rates, and when they dropped to half a point, it was under 4, I believe, wasn't it?
Yeah, it went up over 0.5% in just a month. We dropped like mid-September. It was great rates. I was telling people, lock in, this is good. And then of course, it started coming in fact, right after the Feds announced their 0.5% decrease on the Fed rate.
Yeah.
That's when all of a sudden the bond rates started going back up again. Yeah. And so people are saying, oh, they're going to drop another quarter, 0.5%, maybe 0.75%. No, watch that, because right now we were only about 0.4% from the high that we had here in the last year. So if they've already dropped 0.5%, they're already below where they're supposed to be. Unless all of a sudden those rates start to drop again, they're going to hold it steady. They're not going to drop it more unless there's something even more concerning that they see that we're not, right? Something worse with unemployment or with some kind of recessionary type thing showing up. That would be the only reason they would drop rates now. And if they do, you should be very concerned.
We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. And that's where people like talk about, 3% mortgages and stuff, and it'll get back down there. And I'm same opinion as you. I'm like, if it gets back down there, that $500,000 house you have is probably worth about 300 to 350 is the reason why it got down there, which there's going to have to be something when people are like, oh, it was like that for a period of time. And I'm like, yeah, it was, because interest rates were basically, federal rate was at 0. There was free money and people were just trying to get money out, and there's cheap lending. But now banks have gotten tighter, and I know there's new banking standards that I think it's like Basel or whatever it's called that come out, and how banks now have to rate their loans, and like lines of credit are riskier, so they can't do as many lines of credit, or the bank's ownership or equity would have to kick more equity into the company for reserves, which good luck trying to go get a CEO or top people at a bank to kick in more equity to cover the lines of credit they're giving. No, they're just not going to give them and take on the risk, because they make plenty of money on all the other debt products that they put out there.
That's right. Exactly. There's definitely just there's a lot going on, but at the same time, not as much as you think, right? It is interesting to see what's happening. And this doesn't stop me from investing at all. I think it's still a great market to invest in, even in real estate right now. Granted, I may not be buying self-storage currently because self-storage hasn't really hit that low yet. It looks like apartments are starting to get to that point where now it's like they're starting to find deals. Where, self-storage, you're not finding it yet. But man, lending, I tell you, is still, for the last 2 years, still is like the winner. Because like you mentioned, even though there's more money being supplied, banks aren't necessarily wanting to lend to a lot of people. And so even good real estate operators are having a hard time securing lending. Rather than going with that whole crap of that, they need, even easier, get private money. Give them our private money to where we can get much higher returns anyways.
Yeah. And that's where I was on before this recording. I was on the phone with somebody who basically was involved in the new term now is called residential transition loans, which used to be formerly known as private money lending or hard money. Hard money is now just a bad term that you can't use. It's basically made its way into the, call it correct terminology of RTLs. And that market, this person we're talking about, one of the large providers just securitized the $100 million pool. So they're securitizing those loans, and the amount of money that's out there from a lot of private equity and all these other firms and funds. And part of it they're mentioning is because look at how many homes were built before 1990. How many of those homes now are getting renovated and so forth, or haven't been renovated, that people are going in, they're renovating them and turn around, selling them or turn them into rentals. And most homeowners don't want to do that. And that's what's been spurring the housing market over the last year or two, because the amount of inventory on the market's really low, but also the number of people who are actually looking to buy a home is super low, because, hey, look, I'm not moving anywhere because I love my house. I built my house. But even if I was considering it, I'm at 2.75 or 3% on my house. And I could basically afford, I went out to buy a home today. I go from the house I am in today, probably like my neighbor's house, which is half the size, and it would cost me the same every month.
Yep.
Why would anyone do that? Common sense.
That's right. And that's why it helps. You never want to get locked in just geographically to thinking like the whole country's like you are, right?
Yep.
Because people in California are always like, they never know what reality is because California
that's
like
just a whole different market. Yep.
Totally. Yeah. But you're right. Like I'm in the same boat. Like I bought this house 3 years ago, a jumbo loan at 2.75 for a 30-year mortgage. Even if we want to downsize, because we're getting kids kicked out, we have 8 kids, but now, we have a couple of them already adults.
Wait, how many do you have?
I have 6 from a previous marriage. My wife has 2. So we have 8 between the two of us, blended family.
God help you.
So it's like a Brady Bunch, but there's no room for Alice, right?
Yeah. So, and you need an Alice with 8 kids.
I think I'm Alice, actually.
Yeah, I was going to say, well, you're retired.
I'll tell you, but it's crazy. But eventually we want to downsize. But the thing that keeps us here is if we downsize, why would we downsize to the same payment, like you said, for half the house when we could just stay here and have an amazing thing? And people are like, well, you can turn it to a rental. Yeah, but higher end homes don't really rent well. If I'm going to do a rental, I like if they're about at average or below, right around below the average of that area. So when I do buy rentals, that's what I look for. Which lately I haven't been doing as many rentals just because the numbers haven't really panned out as much on the cash flow side.
Yeah, and that's what, for me, I can't remember last time I bought a rental just because numbers don't make sense. So I know a lot of people might push it and be like, oh, buy rentals. And I'm like, numbers don't make sense. And I'm still of the opinion that we're in for some softening in housing. And we're seeing it in Florida. And again, we invest a lot in defaulted loans. And I can't tell you how many loans I've seen over the last month that were actually fix and flip loans that the person bought it, call it for 400,000. We're going to put 100,000 into it and think they could get 650 for it and make a quick 100 grand or whatever. That house today that they thought was going to be worth 650 has been sitting on the market for 475 and has no takers. And they're basically just bleeding right now. Texas, Florida, some of these other locations, because of a lot of people forget to consider on housing is, well, you have a payment, but what are your 2 other big expenses? Taxes and insurance. And taxes never go down, people. I'm sorry. I've been around 49 years on this planet. I don't think taxes have ever gone down from property tax and insurance. I don't think insurance has ever gone down either. So
it's so true. And that's exactly it. Once I hit about 2021, 2022, it got harder to find a really good rental anymore. Even if you could find one, because then you're fighting with everybody else for the rentals unless you have some good inside connection.
Yep.
And I think what you're going to see on that side is anybody who's banks on appreciation. This is what the mistake I made before the last recession is in 2006. I thought, even 2007, I thought I could buy a $100,000 home, but if it appreciates 10%, I make 10,000. If I buy a $500,000 home, if that appreciates 10%, that's 50,000. So maybe I should go buy bigger homes to make bigger home runs.
Yep.
And that was the dumbest thing ever, right? Because now you realize it's not about the appreciation. Oh, that should be the icing on the cake. It's always about the income, the cash flow, the profit of that comes from that property. And if it's not profitable, don't do it. And don't expect that appreciation is going to work. Because I agree with you. I think we'll still see appreciation in residential, but it's not what you saw. Like you said in the beginning, it's not going to be like the last 4 years. No. Nothing even close to that.
And the thing that I think a lot of people have today, and it's in everything, whether investing or just life, work, getting promoted, everybody thinks everything should happen overnight. Instant gratification of, 2 years, I should be promoted to senior level manager, or whatever the case may be. Or when I started in work, I was in construction management. And, if you were running your own project within 10 years, that was like the greatest thing. And then 20 years after I started, I see people in 3-4 years starting to run their own projects. And guess what happens? Those companies have trouble because they struggle because of an experience. But I'm mentioning this because like real estate, if you're in real estate for the long run, if you're in anything for the long run, stocks, real estate, look, the government keeps printing, there's inflation. So inflation is going to increase the value of that asset, just going to happen. Right. So yes, time can heal all wounds, but it doesn't mean you should be making bad investments or risky investments because of it.
Exactly. And that's why I always come back to real estate, right? You can go try to do Bitcoin, but I'll tell you this, my secret for investing has always been do the opposite of what everybody else is telling you to do, right? If everybody's saying buy Bitcoin, that's the time that Bitcoin's about to crash. If they all say sell it, that's the time it's going to go up. Same thing with real estate. If everybody says, oh, real estate's bad, which we still have an element of that. There's still people that think real estate is super risky, too high priced, which people have been saying since 2015. Let's be honest. They keep saying it over and over again. It's too high priced. Guess what? That's real estate, especially after it got depressed so badly in the last recession. And so you got people that are scared of that. I never hear people, other than me maybe, but I never hear people say, you know what? I like the stock market. Like I think the stock market's going to go, but I think it's going to tank right now. Like most people are just complacent. I'm making money. I'm just going to keep my money in the market. Like they're just sitting very comfortable. And that's when everybody gets surprised, right? Yep. That's what becomes newsworthy. The only thing that makes it news is something that's some element of surprise. Yep. And every recession, people are like, oh, I didn't see that coming. Yeah, because you got complacent. It's when you stop looking at reality, that's when you get caught with your pants down. And so you gotta watch for that. And so real estate, one, it's a real asset. I like that aspect. And even if I'm lending, that's another problem too, is that I talk to so many people who come from the saver mentality that you should own things, but it's not about ownership. It's about control. Banks, that's what banks want. Yeah, banks are on title. Sure, they got your title, but you're on title too. But you're an equity investor. When you own your own property, they're the debt investor. And guess who's going to win every single time if something goes wrong or if you decide to sell a property? Who gets paid first? It's the person that has the debt, right?
I always tell somebody, drive through any major city, who owns the tallest building in that city? And I guarantee it's a bank. It's a bank.
That's the best way to model.
Bank or insurance company, one or the other. But it's interesting, like that zig versus zag theory you mentioned of, I am not the type of person, I'm very similar. And I view it, there's retail and institutional investors. And when I'm like, everyone's like, oh, buy rentals, buy this, buy that. I'm sitting there, okay, what is BlackRock and some of these other big funds that own real estate? What are they doing? And when you start seeing them liquidating certain portions of their portfolio or doing certain things, it's like, why are they doing that? It's like interesting to see. And we invest, again, a lot in defaulted debt. And I was at a conference in Chicago, I think a year and a half ago, maybe 2 years ago. It was interesting because everyone keeps waiting for, at this conference, this was 2 years ago, the quote unquote crash of people defaulting on their loans.
Yeah.
And basically, and they're trying to tell people like, oh, of timing the market and this and that and so forth. But there's been a lot of data and history out there with banks and stuff that banks who bail the earliest do the best, meaning that if you're going to pull the plug on something or you think something's going down the drain, the sooner you can pull the plug on it, the better off you are. And I'm a believer in any type of real estate like that. If you see a deal that's going bad, it's only going to get worse. A construction project, whatever it is, because you're probably, a lot of people have put the rosy glasses on and say, okay, this is bad, we'll make it better or whatnot. It starts to snowball, and then it keeps snowballing to a point of it's out of control, and you could have got out of the deal a while back versus now. And this is why every time anyone's ever asked me, oh, I'm in a syndication that is looking for a capital call. And the first thing I say is, I'm like, don't do it. And they're like, why? Yeah. I said, because they're banking on something they can't control. They're banking on interest rates going down, or somehow magically they can increase the rents that they can't increase, or construction costs go down. They can't control any of that. And because they can't control any of that I'm not going to put my money in something that's not controlled. There's already a level of risk. And many people I talk to who put it in are basically like, yep, they thought interest rates would be down in the 4s or 5s by now, and they're not. And they're probably not going to be for a pretty good length of time.
I totally agree. It's true. The perspective that you have, I know people are usually most optimistic, are usually the real estate investors that need it to be optimistic, right? They're the ones
like realtors. Oh yeah. This house will sell in a week at this price. It's never going to go down. 6 weeks later, you drop 50 grand on the price.
That's right. Exactly. And you have to wait for that humility. You have to wait for that fear before it's a really good time to buy. Yeah. But that being said, I like what you had mentioned too, because people are waiting for a crash. There's still plenty of opportunity right now before a crash. There's always opportunity. Absolutely.
And people say they can't find a deal. I'm like, you're not trying hard enough. The difference is 2, 3, 4 years ago, I use the analogy, you were a farmer. You'd make some relationships, you just go cultivate and everything would grow and just come right to you. Let's go pick your vegetables. Those are the deals. Today, you're out in the middle of a blizzard. with your bow and arrow. You don't even have a gun trying to hunt an animal that is in their terrain. It is hard to find deals. It's not easy. And for people out there raising money, it is hard. I don't care what any guru will tell you. Can it be done? Absolutely. But it is not going to be as easy as somebody tells you to, whether it's finding deals or raising money. But there's still plenty of opportunity out there as well.
Absolutely. Yeah, I agree. That's where I never actively invest anymore. I'm more of a passive investor. And even our clients go to investments like the ones you have. Right? And that's the thing we're always looking for is that operators. I love it when operators tell me, I'm not seeing good deals right now. Like nothing's fit my buy box. But you know what? I'm finding one here, one there. Like they have to like really sift. When they tell me, now I have to look at 200, 400 deals to find the one that I'm going to put an offer on. Awesome. Before you were looking at 10 to find the one because it was just falling in your lap. It was so easy, but that's not the case anymore. And you're adjusting. And I love it when operators don't try to justify and say, you know what? It's not really hitting my buy box, but I need something now because people want to give me money. I got to do something with it. So I'm going to buy this piece of crap. Like I had a friend that, speaking of like debt and stuff, like I had a friend who did a syndication and he did a lot of ones where he was trying to do things that he'd never had experience doing. And he would call them chocolate deals. And because he would call his normal ones, like buying in Huntsville, Alabama, for example, that would be his vanilla. And I tell my clients, like, listen, don't fall for the chocolate. Like he has no business being in that space. He might win, but that risk is gonna be a lot higher than his typical vanilla deals, which he knows like the back of his hand. So be careful. And lo and behold, almost every one of his chocolate deals went south. And even some of them, he tried to do capital calls. Of course, nobody wants to throw good money after bad. And so he couldn't do that at all. And so he's literally foreclosing on some of these properties and giving them back to the bank. And that's the thing you don't want to run into. Now, he did have another deal that was one of his vanilla deals I was in. And it had a little bit of he had a little issue because he was trying to sell it, but it was going to take an extra few months to sell it. So he's like, I need some operating expenses. And I said, all right, cool. I'll lend you the money this time. Which in the funny scheme of things, it actually put me ahead of all the other investors that included myself. Because I had debt. I get paid back first. So I said, yes, put me in. I'll lend you the $50,000 to keep it going for the next 3 months. And then I get paid my 15% when you're done, when you sell. And it, just like clockwork, he did. And he was able to sell it, get out from under it. So I got paid on that with my debt loan. And then I got my equity back too, which was great. And that's where you're starting to see more people. I've noticed more and more operators are not doing capital calls anymore because it's just getting a bad name.
They're doing debt.
They'll do a debt fund. That's exactly it. They'll do a debt fund. They're like, hey, I need to raise $1.5 million. This is a debt fund. I'll pay you 9% per F or 10% or 12% per F, whatever it might be. And that's great. That's good as long as it actually will fix the situation, right? Which comes back to your point before.
The problem that we see is some of them I know are just kicking the can down the road and then trying to line up the next deal to keep the money coming to collect the fees, where they're just ignoring those investors and that deal has zero chance. And we run a debt fund and we've got zero leverage right now in anything. So we got no debt. So it's just our investors. And I see, like you mentioned, like finding deals. There was this one individual we've been working with. We put in last quarter over $25 million in bids to this person. And we did not get one deal. We just hit one last week with this person after all this time. And we're like, yeah, we're breaking through. But we're not chasing. We're not overpaying. It's like, here's where it is. But what also plays to that is, in like you mentioned, the vanilla versus chocolate, people are getting frustrated because the numbers don't work. So they're just pivoting to something they're not experienced with. I know another investor that they're investing in debt. They're investing in oil and gas. They're investing in crypto. They're investing in commercial office. And I'm like, this makes zero sense. There's no way you could even build a team or have an expert in every one of these. And, you know, lo and behold, I've heard rumblings like they have financial trouble. And I'm like, makes sense. So what are they doing? They're going out to raise more debt.
But Chris, they just had a pivot in the market. That's all. It's just a pivot. But it's like, no, you pivot processes. You don't pivot investments, right? That's the problem. Like when you're trying to pivot into something you don't know, have any business doing, that's where you not only, it's so hard to build a reputation, but so quick to kill it. Why would you try to do something like that to destroy your reputation? So
there's this fund out there. I won't name the name of it because it's being tied up in litigation, but this investor who very well-known podcast too, was doing a lot of fix and flip loans where he'd have investors would invest, he'd take the money and go fix and flip loans. And people are going to know when I say what he got into because it's pretty well known, but person like pivoted into Broadway plays.
Oh no.
during COVID, and defunct brick and mortar stores like Bed Bath and Beyond or stuff like that. And people were investing thinking, oh, he's issuing them notes. So it's, oh, note investing, it's real estate. So people were investing thinking, oh, maybe not paying attention. But lo and behold, like person now went from real estate to Broadway plays to brick and mortar defunct stores. Like that's a pretty big pivot to me. Like I would know nothing about a Broadway play. And now basically cease distributions and there's a lot going on and so forth. But I'm like, as you mentioned, that is like you pivot certain aspects, but pivoting your whole entire business just seems ludicrous to me. Unless it's something like you're an expert in. And people ask me, oh, would you do others? If I did something like maybe I could do like new construction or whatnot, I'm like, yeah, because I built $1 billion worth of buildings in my career. And that's what I did for 25 years. That would make sense if I wanted to add a little flavor to that. But if like someone said, Chris, go do short-term rentals. I know zero about short-term rentals. I know zero about self-storage, except that I rented one once in my life. So I would mobile home parks, no idea. So it's not even something I'd even look to consider.
Yeah. You wouldn't even know the questions to ask, right? And even if you make money, I saw a friend pivot into oil and gas recently, and a lot of people are talking. They're like, oh, it sounds amazing. And what he's doing, it sounds like he's just killing it. I'm like, it sounds like it, but he's been doing it a year. What kind of, how do we even know? Yeah. Even if he's killing it now, how many times have we seen people kill it for years and then all of a sudden not anymore? I mean,
ATM funds. Somebody was doing ATM funds and making hand over foot and sent me a thing. I'm like, oh, this looks pretty cool to invest in ATMs. I'm like, you know what? I don't know. It just doesn't smell right. I don't. And lo and behold, everyone's up in arms now because a bunch of these ATM funds are, going under.
I even had my own clients tell me I was crazy because they're like, man, I'm getting paid 26% a year on this ATM fund. I'm like, that's great. But we already know this is a temporary, it's technology based. I never like to invest in anything that's technology based because technology becomes obsolete. It gets cheaper. It loses profits over time. But on top of that, the one thing I don't like either is the fact that we know that we're going to go digital anyways. So why would I invest in something that's going to eventually disappear?
Yeah. When's the last time we used an ATM?
Oh, geez. I think in Mexico.
Yeah. I'm saying, like, what's my PIN? So
yeah, that's right.
Well, Chris, as we wrap up this episode, it's been great chatting with you as always. And thank you for coming on. What's the best way for people to get in touch, reach out and learn more about what you do besides the podcast? And feel free to mention that as well.
Yeah, everything's Money Ripples, whether it's moneyripples.com, at Money Ripples on all social media channels. And then, of course, the Money Ripples podcast.
Great. Thank you all for listening today. Make sure to go check out everything that Chris offers because, again, wealth of knowledge and information, all things investing. And as always, make sure to leave us a review and a like on your favorite listening station. Thank you all. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.